back even quite a few years beyond that. I guess when I was really a teenager, I got quite suspicious about the nature of money, partly because I didn't have any. And so I wondered where it came from and basically who controlled these systems and why certain objects such as gold and silver were worth a great deal whilst other kinds of materials weren't. So I never quite found the answers to that, and I kind of drifted through, you know, sort of a bachelor's degree and a master's degree, and found myself teaching in Bangkok University. And I happened to have the misfortune to be there during the financial crisis. And I have to say, if you've woken up one morning and found out that all your savings have suddenly been devalued by 20%, it makes you wonder, well, how did this happen? I didn't remember George Soros calling me up and say, hey Peter, we're going to devalue all your savings tomorrow, you better get it out of the bank. No such thing. What an inconsiderate chap, I thought. So how did this happen? Clearly the media, I thought, have to be implicated, and since that was my area, I guess that really started my interest in finding out a great deal more about exactly how financial markets worked, and indeed the role of communication systems in them. Because it seemed to me that what was happening in the financial world was a world apart from what was going on in everyday life. It seemed to be a detached sphere of society where it was subject to logics that were completely alien to things going on in the life world. And very few people within the media and communications field were writing about it. So, as a political economist, I wanted to look at the communication systems within financial markets and to explore, by and large, in a big picture way, whether they really were worlds apart. So, if we go back to the 1970s, it was a very important period for finance. There was an exponential growth in financial market activity. Certainly there was a close connection there to developments in media and communications, and particularly a convergence between satellite systems, information technologies and informatics, and coupled with the extension of these global infrastructures around the world, linking together different financial centres, developing new forms of trading and financial instruments. So one of the things we see here is the development of real-time information systems. And that's an important development because when all the markets are linked up and they're all getting all the information about price changes in real time, the price spreads across different markets tend to close up. I mean, historically, if you were thinking about communication in the pre-telegraph era, you know, the news about whether the price of a particular commodity overseas was going up or down could take weeks or months to arrive in a market. And of course the telegraph helped to revolutionise that, but it still wasn't a real-time technology. And in an environment where all the traders get all the information about all the commodities all the time as it happens, the opportunities for arbitrage to sell in a cheap market, to buy in a cheap market and sell in an expensive market simply dry up, and they dry up very, very quickly and profoundly. And that drives traders into new forms of activity, you know, using greater leverage to exploit marginal differences, and also an intensification of their monitoring of market activity, including each other's behaviour and the expectations of how other market actors are going to behave. At the same time in the 70s, there was also the demise of the Bretton Woods macroeconomic arrangement that underpinned the Keynesian model. And what we see there is a shift towards monetarism and neoliberal paradigms of social policy. And within that, there's a great emphasis on allowing free flows of capital across borders, trillions of dollars a day. And freeing up those trans-border flows of capital was very much part of the neoliberal policy prescription. So we see huge increases in the velocity and the volume, the spatial extension and the intensity of financial market trading. And electronic media infrastructures have been absolutely central in underpinning this. And in fact, media systems, of course, aren't just involved in the transmission of market data. They also provide the platforms and the infrastructures for the actual trading activities on stock exchanges around the globe. I mean, the old days of the pit traders, well, they're still around in some exchanges. But the days of the guys in stripy blazers yelling crazily at each other and throwing chips around, you know, is pretty much gone. Most of the trading today goes on in corporate trading rooms that may well be thousands of miles away from the exchanges that they're actually trading on. One of the key developments here are the key wire services. Thomson Reuters, recently bought out by Thompson, used to be Reuters, and Bloomberg in particular. Very, very important platforms for real-time data for trading floors. And increasingly, you know, if you're a day trader, if you're an individual investor, and you're willing to invest the capital, you know, you can have these systems plugged into your living room. So they become increasingly publicly accessible. In addition to that, there have been financial media like CNBC, 24-hour financial news network. There's been several other competitors that have come and gone. And online, there are media like The Street, again, sort of major brokerage house for rumours about financial markets, and opportunities to trade directly from your home computer, facilitated by companies like CyberTrader, Schwab. So these new media have really changed the entire complexion of financial markets. And as this has developed, we've seen an enormous level of financial deepening. You know, in 1980, the level of financial market trading and the value of the assets on financial markets were about 109% of world gross domestic product. You know, that's the total value of what you might call the industrial economy, or the real economy, as some people would put it. It was about $12 million in 1980. By 2006, and probably it's gone up since then, it's around $167 trillion. So it's about 350%, and in some countries over 400% of the actual value of their gross domestic product. So financial markets have come to absolutely dwarf the industrial economy. And just a very, very brief look at some of the developments. I mean, in 2006, global stocks had a daily turnover of $280 billion. Bonds nearly up to $1 trillion, 943. In 1989, foreign exchange currency markets were trading at about $880 billion a day. Now it's about $3.2 trillion. And global derivatives now is about over $4 trillion a day globally. So absolutely phenomenal amounts of capital literally whizzing around the globe through these electronic networks. So you might say, well, if money makes the world go round, it's these communication systems that make money go around the world. So the way that I've tried to look at this from a communication point of view is to focus on what I would consider to be the reflexive dimensions of financial trading. And there's three in particular that I want to point out. And the key point that I'd make in the theorization of this approach is that it's looking at communication not just as a representative form, as news about some other external world, but as communication actually helping to perform and create financial realities. And I think that we can look at this on three particular levels. First level is what I call implicit or performative reflexivity. And this would entail the formation of what I call intersubjective codifications, mutual understandings, mutual schematas, frameworks, reference points, that demarcate particular types of financial security and particular types of financial action as mutually meaningful and having a coherent value that can be conveyed to a broader market. So that would include, for example, the recognition of legitimate monetary forms. It would recognise particular types of financial instruments, sometimes very theoretical and abstract financial instruments, and the models and the schematas and the trading frames that underpin these and allow financial traders to inhabit a mutually intelligible universe. Now, importantly, in this regard, we could argue that financial theories are not just descriptive of what goes on within the financial world. They're actually performative. You know, they don't just describe the markets. You know, even fundamentals are codified. And so theories actually help to bring about the financial realities that they try to explain. And there are several important implications of that. One being, of course, that if you're trying to model financial activity, by the very nature of modelling it and the incorporation of those models into investment decisions, you will change the ontology of the market you are trying to describe. And therefore, as soon as you think you've modelled it perfectly, it will morph into something completely different, which the models then don't fit. There's also, at the second level, is what I call explicit or transactional reflexivity. And this involves the crystallization of prices and notional financial values. I'll talk more about that, I don't have time today. but the fictitious values that Marx talks about in the financial markets will be created here. Because prices need to be confirmed and crystallized through actual transactions and ask-bid spreads. And as those are confirmed on the screens, traders are observing cycles emerging, they're observing patterns, they're comparing them against historical models. And that's an important signal to investors about the way that markets are currently behaving. I mean, you see this all the time. There's a roundup on the evening news, although it won't explain it in any detail, about the the FTSE going up, the DAX is down, the Euronext is stable, the Dow Jones is going one place, NZX is up or down. I mean, these are all cycles of prices that we're seeing. And those price changes in real time reflect the current market valuation. But importantly, those prices also entail an inscription of the future expectations of prices and values into current frames of reference. And that suggests a very important role for the media, because you're not just responding to fundamentals in any reactive way, you're anticipating what those fundamentals might be. You're projecting models into the future about where you think prices for different stocks or bonds or currencies or derivatives could be going, and you're inscribing those expectations into current prices. And that's very important. And in fact, what we see is that high volume trading can drive asset price changes quite significantly. In fact, even small levels of trading in the right market, or you might say the wrong market, can affect those prices. There was a case recently where it was revealed that where oil commodities, oil futures, hit, I think, $100 for the first time in well over a decade, it may have been the first time ever, that was actually created by a single trader trading a $10,000 block of futures. And apparently the guy did it for a bet. It was one trade, made the $100 price go ping, and that flashed across every trading screen in every trading room across the globe. And although it very, very quickly dropped back down, it signalled a change in the mindset of what was possible for the traders. It had hit 100, everyone knew it, it could go there again. And of course what you're seeing at every visit to the petrol pump is that it's still up there. So those changes of expectations are significant, and they have consequences for the productive economy. Now the third type of reflexivity that I'd identify is what I call contingent or gain reflexivity. And this is, I think, where the fun starts in terms of where the media comes in. Because it stems partly from self-referential monitoring by investors, and looking at what each other are doing. Because if you can't get an advantage by getting the information about price changes faster than the next trader, then the next best thing you can do is start to very, very closely monitor trends and patterns in the market to try and second guess what everybody else is doing. I mean, John Keynes wrote about this. I mean, in a rather politically incorrect analogy, he suggests that the financial markets work rather like a beauty contest in a newspaper that he alluded to, where there were pictures of various women who'd entered in the contest, and the readers were invited to guess which one would win. And if they guessed the correct one, they went in the hat to win a prize. Now, political incorrectness aside, Keynes's point was this, that to guess the winner, you didn't just pick the woman that you thought was most beautiful. You had to guess the woman who, on average, would be regarded as most beautiful to everybody else, given that everybody else was trying to second guess all the other guesses. And he says financial trading is like that. The second guessing of these processes is partly derived from getting information about past trends, knowing other market actors' positions in the market, and figuring out where their collective movements are going to drive prices tomorrow. And the media play a very important role in this. There are huge amounts of information that are displayed on the screens. When I visited Deutsche Bank, ANZ, Reserve Bank, there are traders with up to 4, maybe 5 screens on a desk, with a massive, massive depth of complexity in that information. And I asked one trader, well, what are you looking at? You've got all this information, what's important? Oh, he said this line. So I thought, well, gee, I could have had this at home. But what he knew wasn't just the information, it was knowing which information was important.